And the AI technology that it represents is, I think, the future of the entire global economy.
They say Mumbai, goodbye, and hello, Shanghai.
At this moment, I think China is my best choice for now, and that's why we put all our money into this market.
The Chat Lounge. Chat Lounge.
Chat Lounge.
The Chat Lounge unpacks views and opinions on hot issues in a more casual way.
Welcome to the Chat Lounge. I'm Qiang, joining our discussion on how DeepSeek will reshape global equity markets and the Chinese economy are William Li, Chief Economist with the U.S.-based Milken Institute, Dr. Qiang, Fellow of the Belt and Road Research Center, Minzu University of China, and Chen Jiahe, Chief Investment Officer of the Beijing-based Novem Arcae Technologies. It's a great pleasure to have you all back on the chat, gentlemen. Welcome. Chinese equities are hot right now, and according to the world's leading investment bank, Goldman Sachs, global hedge funds have been snapping up Chinese stocks this year. Their buying is accelerating, fueled by the emergence of artificial intelligence startup DeepSeek. So let me begin with Jiahe. How have you adjusted your company's investment portfolio recently? Did you buy any equities of AI-related Chinese companies?
Well, we've been looking at these AI-related companies. When something new like this comes out, a qualified investor would just go to research everything. We try to understand how they're going. We use the DeepSeek and we figure out the industrial chain and stuff like that. But we haven't allocated some of our capital to this industry at the moment because, investment is not only that you buy the best technology or the best companies, but it is also a very key issue is that you buy the companies at a good price that no one has realized. So that's very important for investment philosophy is that you have to do something that others don't do. So when the whole market is currently looking at AI and DeepSeek and related companies, it's pretty hard for you to find a very good price. The valuation just goes up and investors are so enthusiastic about these companies. So currently it's not in our portfolio yet.
All right. To Dr. Chu, when do you see this round of a global buying spree for Chinese equities emerge then?
Well, it's very hard to say because different investors have different choice for the timing. But actually, we can see after the 2023, major investors started to get into Chinese stock market, as you just realized. Actually, in the end of 2003 and in the mid of from the Q2 of the 2024, you will see that the A share in China actually has been bottomed. 2,700 points is actually the bottom for the A share. And ever since that, I think since the Q2 to Q3, the whole stock market is zigzagging to go up until upon the package of the policies at the end of September, and we'll be seeing a major rise in the stock market. There are many synergies behind that. I think there's policy combo, the bazooka of the fiscal financial policies for sure, as well as for the good performance for some Chinese companies as well as for people's desire to rebalance their own portfolios. I think all the synergies has made this major rise up in the Chinese stock market, and also I think behind that, international investors are absolutely passionate about this rise. So you will see from the last National Days holiday. Many investors in North America now dump their money through the Hong Kong market to buy in the A-share market. They say Mumbai, goodbye, and hello, Shanghai. Is their slogan. And I think at the beginning of this year, actually, it's become a major spree of buying in Chinese assets. As you can see, many inspirational facts that's been popped out. For example, the sixth generation of the Jetter fight, and also DeepSeek, and also for all the good performance by the BYD and the leading technology in the auto drive with a brand name called the Sky Eyes. So all these actually inspired the international investors to buy in the Chinese stock. For example, the sovereign fund of Norway, they've been buying in continuously ever since the last year. And if you take a look at the portfolio performances is actually very, very good. So I think many more are coming, and just listen to Deutsche Bank, a very famous, probably one of the most important investment bank in the whole world. They have been issued from last year, actually, several series of the reporters say, okay, we underestimated Chinese, assets, not the traditional assets. I mean, the high-tech assets, the technology companies. We used to say China cannot make an original innovation, but that was wrong. According to Deutsche Bank's report, they say it's time to reevaluate Chinese technology assets. And I think they're absolutely right. Just take a look at the performances from Tencent, Alibaba to DeepSeek, related stocks, to the media-related stocks, for example, the Naja's mother company. And all they're having the huge performance of people's expectations. So I think if you ask when the spree comes out, I can hardly answer you. But I can tell you is that actually this whole trend started from, like 2 years ago.
The trend is quite obvious, but when it comes to the amount, maybe it's not that big. I'm not quite sure. So, William, can you help me solve this problem? And according to statistics from China's Shenwan Hongyuan Securities, last month, the scale of global equity funds flowing into the Chinese market surpassed $3.3 billion US dollars. That's an increase of over 20% from that recorded in December. So what is your reading of the number? Is a 20% monthly rise common in the equity market?
Be careful about looking at flows of capital, especially net flows of capital coming into China. For the longest time, China was considered not investable by most Western investors because it was very hard to do due diligence within China for various reasons. And a lot of companies that were set up to help foreign investors do due diligence, which means find out what companies offer the best investment opportunities, find out more about the management styles of these companies, find out more about how these companies are operating and why they're doing so well. Finding that information is very critical for making an investment decision, whether you're a Chinese investor or an American investor or anywhere else. But for China, that became more difficult. What DeepSeek reminded everyone was that you don't invest in a country, you invest in companies. And I think foreign investment companies are finding that Chinese technology companies, the new energy companies, all of the sectors that in some sense have been put on the list by President Xi 10 years ago in the Made in China 2025 program of giving huge subsidies to these companies to make them the best in the world, the frontier setters for the world, has been very successful in many companies. And now we find that DeepSeek has exceeded the expectations of many investors. So when you think about how much money has come into China and how much money has gone out of China, the numbers that I've seen show that actually the net amount of investment coming into China has actually been negative, which means that more money has left China than has come into China. The reason why is because many of the old industry companies, the clothing manufacturers, the low value added manufacturers that made China so powerful during the 80s and 90s are finding it too difficult to produce in China now. And so investors are finding that those companies, their competitors in other parts of Asia, have become a better investment opportunity. So they pull money out of those sectors. But you're absolutely right that DeepSeek is a reminder that the high-tech industries, in information technology, in new energy, in pharmaceuticals, in technical equipment, China excels in those sectors. And so a lot of investors are now considering the fact that China's market has gone down so much in the last year or so that it's become a huge value game. It's so cheap. It's hard to ignore. And many investors are saying, I've got to put some money in these companies because they are so good and they're selling at such a cheap price, I cannot ignore them anymore. And that's why a lot of foreign money has come back into China in these specific companies.
You're saying Chinese tech companies are having like subsidies from the government, but I think American tech companies are subsidized by capital from around the world as well, Wall Street, absolutely. Right? And
that's right. You're absolutely right. The financing has come from many parts of the world, and whether you call them, venture capitalists or the Chinese government, these are people who are saying, I can pick a winner because these sectors, whether this company or another company is going to be a winner, this sector represents the future of the country. So policymakers, maybe of the United States have been doing exactly that.
Right. Maybe Deutsche Bank doesn't think so. It's just for, the tech sector. It calls it's not just a Sputnik moment for DeepSeek. It believes it's a Sputnik moment for China. We'll come to that later on. But Dr. Chu, you're saying that this 20% monthly rise is common in the equity market. And do you believe like $3.3 billion is a big amount?
No, 20% of rise or inflow of the fund into one market is not unusual, especially for China. Chinese A-share market are famous for its fluctuation. When the market is on the rise, well, probably in one day you only have less than 1 trillion yuan of turnovers, and the other day you're going to have 3 trillion yuan of turnover. So the atmosphere or the sentiment can be changed within one day. We're not talking about 20%, we're talking about 300% change within one day. That is Chinese A-share market. Welcome to the market, which has been dominated by the individual investors. So this is very different from American market, a very large quantity dominated by the institutional investors, or it's very different from European market, small, even though they have both individuals and institutional investors, but they're small size. So Chinese A-share market is very, very different. So I think this amount of money, I don't think it's large enough, because Chinese stock market, out of many foreign investors' common sense, is actually the second largest security market in the whole world already, just next to America. It's more than 4,000 listed companies. So it's phenomenon. So you're talking, if you're saying about the billions of US dollar flowing in Chinese stock market, what's good for that? This money can only burn like 5 days. That's it. So it's not that surprising. But the thing is, how long it's going to last and how high they're going to push up the market, because we think this international investors, they're smart because they are professional. They're institutional investors. For example, like the sovereign fund in UAE, the sovereign fund in Norway, they are professionals. So they always can pick, well, not 100%, but they can always pick good performance companies and also leading the whole atmosphere in the whole market. So I think their performance actually becomes very important, indicators in the Chinese share market. Meanwhile, I think they can help this whole market to get more balanced, more stabilized. So if they can stay in this market for the longer term, I think it's good for the overall healthiness of the A-share market. I think this is a question should we ask. Is Chinese assets, especially the technology-oriented assets, really has been facing a good value? And is all the international investors are willing to get in this pool of assets and stay with China in the technology growth for longer term? Because everybody knows we need more than 10 years to nurture some company like Huawei, like Microsoft, like Facebook or Twitter. So I think this is even for Amazon. Amazon used to be branded as a garbage stock in the American stock market, but now everybody understands that Amazon is a wonderful company. It's not just selling books. They're doing wonderful things. So you need longer term to see these garage startups to grow into the giants. What we are hoping is that with this new performances and awesome breakthrough of Chinese technology companies, we will have more longer partners from the international investment to stay and grow with China.
The Chat Lounge. The Chat Lounge unpacks views and opinions on hot issues in a more casual way.
We'll come to, those questions you just mentioned, like whether Chinese tech companies are of good value to those investors later on. But the Norwegian sovereign wealth fund you mentioned has seen that trend, right? Otherwise, it wouldn't come with real money and invest in Chinese companies. We'll take a detailed look at its investment in Chinese firms lately. The trend became quite evident over the past few weeks, but Norway's sovereign fund seemed to have moved earlier than many others. And according to its financial report, as of the end of last year, the fund's holdings in the Chinese stock market rose by about 18% to nearly $48 billion US. I'm not quite sure how aggressive the increase was, but dive deeper into its composition. Leading internet giant Tencent was the fund's largest holding in China, and the market value of its holdings in Tencent rose over 70% annually last year. And among the fund's major Chinese holdings, the market value of online retailer Pinduoduo shrank slightly. The market value of Alibaba increased by 1/4, and the market value of tech firm Xiaomi Group went up by 170%. So, Jiahe, what are the implications of these changes for the Norwegian portfolio or for other market players like your company?
Well, I think for global investors like the Norwegian fund that you have just mentioned, or a domestic investor like us, or any funds from Europe or America, as long as they can make sure that their government is not having any political issue with China, then I think they should keep on investing into China, like what we have been doing. I mean, of course, we are based in China, we are Chinese, so we don't have a problem with the government as well. And we got our investment portfolio 100% investing equities in both Asia and Hong Kong markets. But what I'm saying is that for some investors coming from the United States, as we have seen, is that the U.S. government has actually stopped them from buying Chinese companies. And I still remember that was about 5 years ago, American investors were asked to sell their holdings in China stocks, especially like China's giant telecommunications companies. And this dumping was absolutely wrong because it lost about 100% growth in the coming years. And we were very happy to pick up these stocks. But anyway, as long as you don't have any political pressure from the government, then I think it's a very good idea to invest in China, because that's what we have been doing. I mean, we got our stocks, holdings 100% investing in both A and Hong Kong markets. And that's because of various reasons. First of all, this is a very giant economy, a very stable economy. I mean, if you look at China, we don't have wars. We got a very ordered market. We got a very stable society. We got very low crime rate. I mean, come over to China, you can work on the street at 2 a.m. in the morning, and you're not worrying about much crime at all. You can't do that in many cities around the world. So this is a very stable and very large market. You find a lot of opportunities in here, and it can actually absorb a large amount of money. I mean, throwing in 10 billion into this market doesn't really mean much sense. You get enough liquidity for even a very large amount of money that you throw in. I mean, compared with other smaller economies, for example, Vietnam. I mean, if you throw like 20 billion yuan into Vietnam, then you probably find you can't find much targets because the market is way too small. But China's large enough, and we got enough channels for people to put their money in. I mean, the Shanghai and Hong Kong connection program, the Shenzhen and Hong Kong connection program, you can throw in billions over a day. So it's a large market. It's a lot of opportunities. And there's also one more reason why investors should come over to China is because we are a developing market. We're not a developing market like a very matured market such as London. And if you go to markets like London, it's a pretty good market. It's ordered, it's stable. But the thing is that you don't have enough investment opportunities because the market is too matured. Everyone knows how much the businesses are working. You are facing the businessman who got tens of years of experience to trade in the market. It's pretty hard for you to get an opportunity there. But China is a developing market. You see a lot of mispricing here. You see a lot of market fluctuations. Market goes up and down. Good companies sold at very bad price, and sometimes bad companies sold at good price. You keep on getting profit from these fluctuations. This is something that you can't find in matured economies or mature markets. That's why I think at this moment, I think China is my best choice for now, and that's why we put all our money into this market.
Right. William, you have any different opinion here?
Well, if you ask about the Norwegian fund, it's a very famous investor who heads it, Nikolai Tangen, who is well known to be a contrarian investor. A contrarian investor is someone who tries to look at stocks that are out of favor and invest in those companies because he believes that the perception that those companies are out of favor is wrong. So Nikolai has really done a great job around the world of finding countries and sectors and companies that have fallen out of favor for one reason or the other and investing a lot of money into it. And China has benefited from that strategy. And I think one thing that is absolutely right that Jiahe has said about the A-share market in China is the volatility creates a lot of value because the excessive volatility means that there are times when the Chinese stocks are just mispriced. And Nikolai is one of these guys who jumps in there and takes advantage of that. But that's a trading strategy. And it's good for portfolio managers who, where people have investment horizons of maybe 3 to 5 years. But a sovereign wealth fund, like the one that Nikolai runs, has to worry about generational wealth. He has to grow the wealth of his country for the time when Norway runs out of oil and has to live off of the wealth holdings in the sovereign wealth fund. And he chose China because he found so many companies that were mispriced, and not just mispriced in the short run, but mispriced probably in the long run, that the markets are not perceiving the growth opportunities that are there in generational terms. So I think that explains a lot of why the Norwegian fund and a lot of other sovereign wealth funds, the Middle East, for example, has joined in a lot of that China investment strategy, because the Middle East, wants to, in many ways, wants to participate politically with China in its Belt and Road strategy. And so I think the joining of interests by many of the Middle East and Norwegian sovereign wealth funds represents a shift in diversification strategies and also in this contrarian investment strategy of looking for bargains. So I think that explains a lot of those inflows that you were asking about regarding the sovereign wealth funds. They're looking for bargains, but not just short-term bargains of the sort that maybe Jiahe is looking for, trading opportunities to make 100% profit within a 6-month period or a 2-month period, but rather over the next 5, 10, 20 years, can they grow their wealth beyond what other opportunities give. And contrarian investors are famous for pursuing these out-of-favor companies. Let me remind everybody, though, that that's just one strategy. And contrarian investors right now, in the last 3 or 4 years, have not done well because the growth strategies that other investors have used of picking companies that have high growth potential and paying a high price for those companies because they represent such good growth opportunities, those strategies have actually done better than the contrarian value investors that Nikolai represents. But a market consists of many strategies, and these are just two extremes. But the contrarian strategy has been one that has favored China by a lot of sovereign wealth funds.
I think Jiahe is also a long-term investor, right? Or you're a short-term speculator, Jiahe?
Well, it's really hard to distinguish. I always say that we have a long-term vision. We look at companies at 10 years or 20 years, we think about this. But we look at investment opportunities that might exist every week, every month, or even every day. So that's a very interesting thing. So we stick with value. We always stick with value. We don't trade any stock. If we think it's going to rise in the next 3 months, we're not going to do that. But we trade the stock because we think it's worth of something in the next 10 years. But if we found out that there's another company worth more than this stock in the next 10 years, next week, then we're not bothered to trade. So we keep on trading, but we look at very long term. So it's really hard to distinguish us. I mean, if you say, are you looking at long-term things or short-term things? Yes, we're looking at long-term things. But are you holding your stocks for long-term or short-term? We might hold it for very short-term, but we might hold it for a very long-term either. So the period of stock holding is not something that we are really focusing upon. But we have a very long vision. That's right.
All right. And William just mentioned a lot of Chinese stocks were mispriced or misvalued. Then, William, to what extent do you think those stocks are misvalued, or how reasonable are the valuations of China's tech companies right now, especially when compared with those of their U.S. counterparts?
Well, I remember I said perceptions of valuation, right? Misvaluations. And that's really the game in the market.
All right.
There is no absolute right answer of, is it misvalued or not? If it is, then of course everyone's going to jump in and then take away that misvaluation immediately. But it's because people have differences of opinion.
There is a commonly acknowledged range, right? No?
Well, but because opinions vary so widely among the population, that's what allows you to have perceptions by some, oh my God, this is such a bargain, and others will say, my God, that is a stock, no matter how cheap it is, I'm not going to touch. And so that's those two attitudes is what makes a market. Right?
And then what's your valuation then?
Of the China market in general, I don't believe in a valuation of a market because it's not the stock market that matters, it's the market of stocks. And some companies are fantastic buys, and other companies are not so good buys. And I don't invest specifically in companies in China, so I really I can't express an opinion, and I really shouldn't, because what I do express, I have learned from our strategic partners at Milken, and I am not allowed to share that. But I'm giving you the general impression, which is that there is a wide range of opinions about where the investment opportunities are. And contrarian investors of the sort that Nikolai Tangen represents feels that much of that is owing to the volatility that is so characteristic of the A-share market. And even more, the bigger opportunities are in the private equity markets, where the companies have not gone public yet, and investors try to get in on opportunities of companies that are still held in private. So that's where the big gains are. But you pay a price because those are not very liquid companies, so that if you want to get rid of it and get out of that investment, it's very hard to do so. So you pay the price for those higher investment opportunities with higher risk. So I think that's why there's a wide range of valuations and a wide range across different companies in China. But overall, the China market has been perceived as more investable now because the Chinese authorities now have put in stimulus packages. They've tried to revive the macroeconomy and made the opportunities for the good companies even better. within China. And that's why, as the last fall, when the counter-cyclical measures were put in by the government, there was a huge surge in investment interest in China because they say, wow, they're going to fix the economy, so the good companies are going to do even better there. It's time now to see where the mispriced companies are and try to invest in them early on.
But yourself don't necessarily agree with Nikolai, or...
I am not a contrarian investor, so that's why I personally don't agree with him. But believe me, there are many, many very, very successful investors that have followed that strategy.
This has been the Chat Lounge. When we come back, we'll check out how long the momentum will continue. Stay with us.
I cannot marry you while your mother regards me.
Step into the world of timeless elegance with Mrs. Spring Fragrance, a captivating audiobook by Edith Eaton, read by Man Ling.
Because the green leaf still clings to the bough.
Experience the lively yet complex lives in Chinese American communities at the turn of the 20th century as Edith Eaton's delicate prose weaves together themes of tradition, change, love, and identity.
Forget all that belongs to the joy of life.
Follow the journey of Mrs. Spring Fragrance and witness the struggles and fights of those living on a rapidly changing exotic land while holding on to their cultural traditions, or more importantly, to their identities.
He could hardly believe that his daughter was seriously opposed to becoming the wife of such a good-looking, prosperous young merchant as Wang Ling.
Join Books and Beyond for Mrs. Spring Fragrance. Let the stories come to life in your imagination. Subscribe to Books and Beyond for free on your favorite podcast platforms, or log on to radio.cgtn.com for more.
Welcome back to the Chat Lounge. We continue our chat on how DeepSeek will reshape global equity markets and the Chinese economy. William, do you believe that tech firms like NVIDIA on Wall Street are overly mispriced or highly priced?
Yeah, absolutely. Companies like NVIDIA that are very famous for being a technological marvel are perceived by very many investors as being mispriced. There are some people who say, I won't touch NVIDIA with a 10-foot pole, and they're looking for the next NVIDIA. And others say exactly the opposite. They say that NVIDIA is cheap at any price right now, and its price-earnings ratio is so low because it just grows so rapidly. Its revenues are growing much faster than people even can forecast. Every time they report earnings, everyone is surprised how strong they are. So those differences in perception is what creates these investment opportunities. So you could get perceptions of misvaluation both on the upside and on the downside.
Okay. And a report carried by the South China Morning Post last week said China's technology companies traded at half of the valuation of the Magnificent Seven U.S. tech giants. So, Dr. Chu, what's your take here then?
Well, I think just as I mentioned, the valuation as science, starting from the period of time, the Markowitz. But also, it's something based on people's expectation. I just mentioned expectation and what people believe and people are confident about is very important. Based on what we just talked about, that international investors think, well, originality and creation is the thing of America. It's not the thing for China. China is good in the manufacturing, labor-intensive industry. That's it. So they try to evaluate Chinese companies based on the traditional manufacturing enterprises. But for America, they use the gross market technology stocks standards to give them the evaluations. So for China, they've been using a very different pattern to do the math for the capitalization. That's the reason why we are much, much lower, evaluated than counterpart companies back in the U.S. For example, like we just mentioned, like 3 months ago, I'm telling people, actually, that is already very obvious. I'm telling people that you should buy in the Chinese gaming industry stock because Chinese gaming industry, for example, is very, very good. You see all the famous studios and gaming companies are from America. But you have to understand that many of their games and certain parts of their games are outsourced to the Chinese studios. So we're doing the hard work for the famous brand, for example, like the Front Software in Japan, like the Ubisoft in America or the Rockstar Studio in America. They all have Chinese outsourced companies, but the Chinese gaming companies, even though There are many of them, but still are not evaluated at a correct price. And even though like 3 years ago, the Chinese gaming companies has already been championed in many subsectors, for example, like the miHoYo, for example, like the Genshin's company. And they have been doing perfect, but the related industry are still undervaluated until we have the Black Man's Wukong triumphed in this year's ARPG. But still, this industry is under-evaluated until we have Naja. While animation and the gaming industry are just, two apples out of one tree, right? So just take a look at the gaming ETF in Chinese A share. They've been rise up within just 1 week, probably 14 or 15% straight. But even they're growing up in the price so fast. But if you take a look at the price of the Chinese gaming companies like 37 Interactive Entertainment, like the Shengda, and all these companies' evaluation is not only like a 1/2 of the American counterpart studios, maybe just a 1/20th of their evaluation. So I think that there is much of the potential needs to be exploited out of the Chinese companies, and this is just one thing. And also take a look at the BYD. I don't think BYD is second to none. BYD is as good as I think of Tesla, and a very great car if you drive one. Top-notch technology, but their stock prices is only like 378 yuan per share, and their whole capitalization is just about to rise like 1 trillion yuan.
So you're saying it's not a correct price. How would you define it? And does that mean there's a good value, like you just mentioned, for investors?
Yes, longer value. I'm going to wrap this up with just one stupid story of myself. I used to buy. I'm one of the earliest buyer of the BYD share. I bought in like 22 yuan per share, and I sold it at the price of the 88 or 90. And now take a look. It's already more than 300, nearly 400. I thought I have made more than 100% of the profit out of the stock. But what I have lost is more than 300% of the profit in the future. And I think if you do not buy in Chinese technology right now, you're going to be regretting this as much as I do.
When was that then? Dr. G, when was that? When did you sell it, or when did you buy it?
Yeah, I kept the stock in my portfolio for over just more than a year.
That's a medium-term investor, if you will. Not sure. But obviously, we've seen a lot of momentum right now, capital pouring in. But maybe this is a little bit early to ask this question. Like William mentioned, perception is very important. But as global institutional investors chase China's tech companies, there is this concern maybe they could stir up undesired bubbles in China's equity market. I know that it will take some years before we reach that moment, but Jiahe, is there such a concern for you?
Yeah, I mean, if you look at the stock market, you always get what we call is that there is an intrinsic value or the fundamental value for every single component, and you can make an valuation of the component. But the problem with the stock market is always that people either trade above that intrinsic value or they trade below that value. The stock price rarely stay around that value. So if we talk about tech companies, yeah, I mean, it's quite possible that when investors rushing in, they create a stock bubble, and the bubble would be much higher than what we call the intrinsic value. Another thing with stocks that are technology companies, it's pretty hard for you to determine the real intrinsic value of a tech company. For example, most of the companies we are trading are traditional companies. For example, airports, shipping companies, nuclear plants, these kind of companies. It's much easier for you to value these companies and bring a proper intrinsic value to them because they are quite stable companies. But if you look at tech companies, especially the tech companies that are using the leading technology like DeepSeek, these kind of technologies, the question is that you don't really know what's going on in the next 5 years, how much money they're going to make. Probably they're going to make 20 times more money than they're doing now, or probably they're going to make maybe the same amount of money as they're doing now. So it's very hard for you to determine the intrinsic value. That's a hard thing for people to invest in tech stocks. But overall speaking, it's pretty easy for the market to form a bubble with the tech stocks because they are amazing. I mean, they're much more amazing than traditional companies. I mean, traditional companies, for many many investors, they're just too boring. I mean, if you ask many investors about traditional companies, they probably never heard about them because they're not in the news. So no one has ever noticed these companies. But the tech companies, they are the stars of the market. I mean, all the media reports them every day. Everyone discusses them. So it's actually pretty easy to form a bubble with these leading edge tech companies.
Right, William. I think just now you had some comment on Dr. Chu's painful experience, but I just interrupted there. Did you? Or...
Sorry, just a little interruption.
All right.
I just missed the spell. It's 44. I bought in at like 44 yuan and sold it like 88. So you just double the price. That's it.
Right. Your memory is just vivid.
Well, I think that Chu's experience is one where it goes to the saying that bears make money, bulls make money, but pigs get slaughtered. And you should be happy with the gains that you have rather than the woulda, coulda, shoulda gains that you could have had if you were to do something else other than what you did. So regret is something that most investors show. But I think in the China market, to get back to your question about dangers of buying sprees, I think one of the things that gets markets out of valuation is what people perceive as the total addressable market, the market that the company is able to sell into. With new technologies, everyone thinks, my God, everyone's going to have an AI assistant robot in their home, and that's going to do so much. And so everyone's going to want to buy them. So we think about every household in China will get one of these things. That total addressable market is unrealistic for one company. So I think those perceptions about how much can happen if you were to allow this company to run are the sources of the misperception. But in the history of Chinese stock market, just to correct something that you may have said earlier, foreign investors are never the source of any stock market bubble in China. It's always been the domestic investor, because the domestic Chinese investor has always been known worldwide as a punter, right? Someone who just goes in, cashes out at a very quickly whatever profits they have, certainly within a year. And rather the notion of a long-term investor, meaning 3, 5, 10 years, is something that is foreign to a lot of domestic investors, which is why many of the Chinese regulators wanted to have more institutional investors come in, because they are much more disciplined, and they have, by mandate, institutional investors have to have horizons that are within the lifetime of the institutions that they are trying to represent: pension funds, endowments, and sovereign wealth funds. So those, we have to talk about multi-generations of people, and that forces them to tie their investment strategies away from the more bubble-like strategies and bubble-like companies that might exist.
Right.
So I think one way to stabilize China's market is to have change the composition away from the punter to the institutional long-term investor.
Then, according to your understanding of the Chinese stock market, are we going to see a scenario where tech stocks are overheated while other stock sectors may remain lackluster or even go down in the Chinese equity market, William?
That will be true, because that is true of every stock market. If you look at the U.S. stock market, the Magnificent Seven consists of exactly these companies where people perceive their total addressable market, their TAM, to be enormous and grow even faster than enormous. and that kind of over-optimism is what leads to these kind of bubble-like phenomena. Some companies actually are able to live up to that reputation, at least like NVIDIA so far, but projecting forward, right, will they be able to do that? Tesla has not been able to live up to that image, and now they've tried to change the image from a car company to a technology company and AI company, and has lived on that kind of perception for quite a while now. So I think for China, as long as the growing companies are in these hard to fathom, hard to understand sectors like AI and science fiction type stuff, the danger of having bubbles will be very, very real, especially when you add that to the decline in the number of traditional companies that have moved out of China for other places in Asia because it's cheaper to produce there. So you have this two trends going on in China. The traditional companies where valuations are easy are moving out because they're finding other places to produce, and the higher tech, harder to value companies are growing in their place.
Right. And then would you recommend Dr. Chu or investors like Dr. Chu buy tech stocks like BYD right now?
would never give advice to my two colleagues here who are clearly better investors than I will ever be. They've forgotten more about investment than I know. So I would never give advice to them. But as an economist, one thing to keep in mind that I've always reminded other investors as my role as chief economist at Citibank and other places is that investing in an economy is not the same as stock is investing in an economy, but you need the economy to do well to provide the background in which these companies can make profits. If the company is in a country whose economy is doing badly and domestic economy is doing badly, no matter how good the technology, the market valuations will never be as high as the same company located in another country where that domestic economy is doing well.
The Chat Lounge. The Chat Lounge unpacks views and opinions on hot issues in a more casual way.
All right, then as an economist, what's your evaluation of the outlook then? Goldman Sachs expects Chinese breakthroughs in AI development and application could materially alter the stock market trajectory, predicting benchmarks will rise about 20% by year end. And Deutsche Bank stated in its latest report this year, the valuation discount of Chinese stocks is expected to disappear with the bull market in A shares on the mainland and stocks in Hong Kong continuing to exceed previous highs. So, Wim, are they overly bullish?
I think those are very reasonable scenarios to consider because of the deep discounts that the companies in China have been put under right now. And the success of the Made in China 2025 program of 10 years ago shows that when the government wants certain companies and certain sectors to succeed, they make sure they do succeed. And so most foreign investors come into China to partner with government money. When government puts its money in, the foreign money will follow.
Right. So you are quite optimistic too.
Well, because a lot of Chinese money is going into these sectors, yes.
All right. Then, and for a quite long time, actually, many economists believe that productivity was a major factor restricting faster development in China's economy. So about the implication of this stock market surge or frenzy about DeepSeek, what are the implications of AI tools like DeepSeek for the real economy then? William and then Dr. Chu.
DeepSeek and the AI technology that it represents is, I think, the future of the entire global economy. The likelihood of productivity enhancement is very, very high. The problem is implementing that and executing it. And so we have to transition from hardware to software and find the applications that will indeed make a high school graduate as productive as a PhD. And I think those are the things that China is trying to do, as well as every other country in the world. And anywhere you find tech sectors and tech companies, they're all trying to find those killer applications that will enhance technology's role in productivity. And key to productivity and high wages is getting that AI in place so that everybody can use it. And that we haven't seen so far.
And Dr. Chi, have you seen that?
Well, I think the whole market get it all wrong. It's not about productivities. We have already get very good productivities, well, not only in China, but also in Europe and America. I think the current problem, structural problem for the industrial countries are oversupplies versus limited demands. So I think more important than productivities, what we need to have is creativity, so to create the new things. A lot of people say, the 101 of economics is supply and demand, right? Everybody knows that, supply and demand. But who goes first? Who actually decide who? It's more like a question of chicken and eggs. Who goes first, egg or chicken? Well, now I can give you a very clear answer. In a current stage of industrialization, basically is the supply decided demand, not as you thought. Well, you lack of demand, so obviously it should be the demand decided supply, right? No, wrong. It's a supply demand, or decided the demands. The reason why is just take a look at the efficiency. You thought you can produce more, but actually the demand didn't buy it. For example, like 20 years ago, the wildest demand for you is to have on the telecommunication is to have the best Nokia. Until one day you got an iPhone from Apple. And then you suddenly find out all your demand has been changed of this new supply, of this new innovation, this new creativity. And whole ecology in the business has emerged. E-commerce, live streaming, and everything popped out. And then the 4G, 5G, and everything. And now we got AI. And when people are saying that Chinese people do not like to watch movies, boom, here we have Naja, and then we have made just a 10 billion yuan within days just with one movie. This is phenomenon in China. And also the DeepSeek has also aroused a similar kind of the trend. So now you see it's not about productivity, it's about creativity. I think that's the fundamental reason why American technology companies are evaluated as much, much higher capitalization, more than Chinese counterparts. So I think right now, China has proved we can do equally good or even better in creativities, in originalities, other than just productivities. So I think that's the reason why a lot of companies started buying in China. But don't get me wrong, I'm not saying that DeepSeek is going to be the ultimate winner. I'm not saying that BYD is going to be, the future Apple. Well, they should be, but they're not 100% sure. What I want to say is that there is one thing to be sure, is that China is 100% sure to be one of the most important player in technology in the future, in originality, creativity, innovation. That's going to be sure. I'm not saying that DeepSeek is going to be a next Amazon on its own track. Maybe there's going to be some DeepSeek or DeeperSeek companies replace them. But maybe 5 years later or 10 years later, we're going to see some major company with high technology in China, and it was very, very mature monetization strategy and business model. It's going to pop out in the world and leading the whole world in its own silo. It's going to be very, very possible. And I think that's the reason why international investors do not want to miss it. They have already seen this before, well, maybe just for a few players, like what we know, Alibaba, Tencent, when a lot of the world didn't buy it. Some investors, they bought it and they won it. And now it's time to fully embrace China and fully embrace Chinese technology and capitalization. And this is just a beginning.
All right. Then, Jiahe, whose side are you on? Have you seen any specific examples of AI tools like DeepSeek being perfectly or sufficiently applied in the real economy or in our daily work or in our production?
Yeah, definitely. I have personally been using DeepSeek these days while I'm working a part of my job on the Chinese traditional literature. I mean, one of my personal interests has been reading the ancient documents of China that has been 2,000 or 3,000 years old. And one of the most problems that I have ever met is that many of the characters that I'm reading are no longer used in modern day Chinese language anymore. So you have to keep on studying them. And sometimes you get a sentence that came from a book that was written about 2,500 years ago, and you don't grab the meaning of this sentence. Even, as we say, every character in the sentence, but you don't know about it. Previously, we have to go to the dictionary, we have to use the searching engine, we have to go through all these things, and it's pretty difficult because sometimes these characters are just too rare. We have to go through various pages. Finally, you probably can find it or not. But DeepSeek is offering a better choice in this aspect compared with search engines that we were using before. They give you a full analysis of the meaning of the this character that you never met before, and it gives you all the possible explanations. I found out that about 80% of the chances is that it gives me a better choice at faster speed compared with the traditional searching engines. So this is a small area that I personally found out is pretty useful. I mean, this new AI system is more like an advanced searching engine for me. I mean, much better than the search engine we have been using before. So I think it's definitely applying in many other areas as well. For example, the scenarios where you need to answer the questions of clients, all sorts of things, and they are developing the next model because currently the DeepSeek offers a general model that answers almost every question. It's pretty interesting and pretty amazing to the social public, but one problem is that it's not that accurate. So I heard that they're working on a more specific version. For example, they will offer you a version, say, okay, DeepSeek with finance, or DeepSeek with physics, or DeepSeek with very specific area, and that I think can give people much better choices of answers compared with what the general model can do. So that will be a lot to expect in the future, and that's the saying that when they got a new technology, it takes a while for the society to find out the best use of that. So currently we're just having the technology, and to see its full employment, we will probably need another 2 or 3 years.
And back to the outlook of Chinese stock market. Nearly a year ago, we asked whether the Chinese stock market was the world's best value proposition, in which some people were quite confident, while others were not so certain because of the ups and downs and lackluster performance of the battered Chinese market. Now, it seems investors are more assured about the upward prospects of China's equity market. So, William, how long? I think it's also a question would be asked by many. How long do you expect the momentum to continue?
I think the momentum in China's stock market will be very short-lived if the domestic economy doesn't come back in line with the kind of growth that we saw in the past, or at least close to it. If we get below 4% growth in the domestic economy, I find it very hard to believe that we can have a sustained rise in China's stock market, notwithstanding the fact that there are such wonderful companies there. They just won't have a chance to grow fast enough to live up to its valuations. So I think China is a good value, but it's also a high-risk market. Risk-adjusted, China, to me, is not the best place in the world to put investment money right now. But it is a good place for diversification, and that's exactly what many of these sovereign wealth funds are doing. They're diversifying into China because they don't want to miss out on a potential winner, but they're not going to bet everything on that one stock market.
And you don't expect the world's investment landscape to change that much, at least for now?
You mean, will I expect the world to rush to China and dump more of a larger share into China? No, I don't. And that's the message that I've heard from many of the global investors out there. China is an interesting place. I don't want to miss out. I'm going to put some money there, but I'm not going to bet the farm on it.
Jiahe, what's your take here?
Well, it's difficult to say. I mean, we see the tech companies keep on growing every day. Today, the Hang Seng Index rose by about 3%, and the traditional companies actually stayed, rose about less than 1% compared with yesterday. So it's basically the rising of the stock market today came from the tech company in Hong Kong. If we look at the valuation right now, I mean, I know it's sounds pretty silly to look at the valuation of tech companies because the tech bubble in 2000 and the United States has taught us that you don't look at the valuation for tech companies. If they got started, they got started. And they go to somewhere around 100 or 200 times PE ratio. But anyway, from the level of valuation, which is still something that you have to look at, is that China's tech companies currently is a bit more expensive than they were at the bottom, but it's not that expensive. I mean, if you compare the valuation right now of the overall sector, I don't say individual companies. I mean, some individual companies are pretty expensive, trading at 200 or 300 times PE ratio. That's definitely too much. But if you look at the overall tech industry, they're trading at about 30 to 40 times PE ratio. So in a developing economy like China, that's not a very expensive valuation. So it looks like the trend is still going on.
Okay, last but not least, Dr. Chu, please.
Well, I agree with Jiahe. It's very hard to say. Investing in the growth market, especially technology, is never easy. It's going to be very, 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 very turbulent. The money-making effect probably will last for like 10 to 20 years. But during this 10 to 20 years of the growth corridor, you probably will face like 10 times gain in half of a year and then 20 times of loss in another 3 months. And then you come back with the 20 times of the game again. And then you lose like 40%, and then you have like 300%. Something like that is always the story. Just take a look at the performance of Tencent, Alibaba, Amazon, Uber, Twitter. This is probably the game it is until they become really mature like Maotai. And then, like Jiahe has mentioned, we don't like it. Matured business means they're very boring. We don't like it because they only have the average return of the performance of the capitalization very similar to their ROE, usually about 10 to 15%. So no story to tell anymore. So I think, for me, the answer in simple, yes, the money earning effect can be, very, very long. And this is just one beginning year of China. We're looking at another 10 years at least. But also you need to get prepared for this very huge turbulence in the stock market for the tech shares, because this is what the nature of tech share decided, not only in China, I mean in America, in Japan, in South Korea, every market is the same. So that's how you're gonna, get yourself ready for this kind of investment.
Well heard. And I myself am not an economist nor a professional investor, but let me quote a Chinese proverb which goes, 30 years on the east side of the river, 30 years on the west side of the river, which means prosperity and decline never last, and everything in life is cyclical. We'll have to wait and see. So with that, we wrap up this session of the Chat Lounge. Many thanks to Dr. Qiang, Fellow of the Belt and Road Research Center, Minzu University of China, Chen Jiahe, Chief Investment Officer of the Beijing-based Novem Arcae Technologies, and William Li, Chief Economist with the US-based Milken Institute, for your time and insights. Show is available on all major podcast platforms. Email us your comments at radio@cgtn.com. I'm Tuyun. Thank you for listening. We'll have more chat at the Chat Lounge next week.
I was born on the 17th of November.
Delve into a world of words with Books and Beyond, a podcast made especially for audiobook lovers.
I came into the world as the youngest of 5
children. I wondered what Her Majesty would be like.
Fie upon you, limpid one. Why have you taken...
Immerse yourself in gripping stories and timeless classics from the comfort of your own personal space.
Sun Tzu underlined 3 points on the context game
There was
initiative.
no better wine, and not to mention the...
Whether you're a bookworm or a casual listener, our carefully curated selection of audiobooks will transport you to new worlds and stir your imagination. Subscribe to Books and Beyond and start your audiobook adventure now on radio.cgtn.com or your favorite podcast app.